Well, good morning, Bob.
Good morning, Bill.
This morning we're talking about underwriting. And it seems as though some of the institutions have really had trouble getting their factory, if you will, their underwriting correct.
Well, it's in the old days, you would have the appraisal come in
When we were young? Was that the old days when we were young?
When you were young.
No. Yeah. Well, what was it when you were young?
Well, they didn't have appraisals back then.
They just got a good feeling and did the deal.
You just knew the banker and you went up
Shook
to him, shook his hand, and you were done.
Away we went. Okay, all right. So go ahead.
Well, in the old days, you had people who would go through each appraisal and they would try and understand exactly what the appraisal was and whether it was any good or not, and whether or not they felt the value was good.
So judgmental analysis, like they used to do judgmental credit analysis.
Exactly. And then over time, they started trying to automate that more and more. They sometimes use an AVM to check on the value. We introduced the GAR rules and the appraisal score.
You don't accept their appraisal rules.
Right. And so we had a process where these tools were being used to help segment the appraisals for different levels of review. And now what we're finding is that the OCC is saying, what you've got to do is you've got to actually touch and look at every single appraisal.
Well, let's step back and let's go and let's talk about credit analysis. Before 1995, let's don't say the old, let's say before 1995, all right? Before 1995, the way an underwriter analyzed credit is they looked at your credit report. The bank pulled a 3-bureau MERS report, and they looked at that credit report and they made a decision. They call that judgmental credit analysis because someone making a credit decision looked at the credit information and made a judgmental decision. Now, we all obviously have bad days and bad times within the day. So at 3 o'clock on a Friday afternoon, when you're trying to get out the door, you've got to finish this loan.
Speak for yourself.
Well, okay, at 3 o'clock on Friday afternoon, people want to go to the beach and they want to go out and do things and go to the local party or pub or whatever. And they tend to be less focused. So mistakes occur. And then, as a result of that, at least the examiners believed in the 90s, we tended to have a higher probability of discrimination. And so Regulation B, which implements the Equal Credit Opportunity Act, that's a non-discrimination act,
right,
lending act, said, look, if you will go to an empirically derived and statistically sound credit scoring system, we'll give you a safe harbor against claims of discrimination in lending. Seems logical.
Absolutely.
Okay? So you're letting a routine that is consistent and it's the same at 3 o'clock on Friday afternoon, make that credit decision. And people say, well, this one over here didn't work. Well, it's based on a large sample.
Right.
And so it has certain characteristics to it. Well, let's now come over to collateral. And let's talk about looking at every one.
Well, I don't think that they're requiring people to look at everyone to the same degree or to follow the same procedures, okay? So I think they are saying that you can use tools to segment these into different levels of review, but what they are objecting to is any appraisal that is getting an automated review and no one is physically looking at that appraisal.
And there's a lot of merit to that standpoint.
Well, I think I think they're a little bit gun shy after what we've gone through.
Absolutely.
And a lot of appraisals went through that were clearly erroneous, and so now they're being more conservative, and so some of our clients are looking at ways that they may be able to convince the regulators to back off of that a little bit and say, okay, if we can come up with something that's, say, equivalent to the credit side of things, where we can automate that review in some way, and it does do a detailed review. After all, you've got an appraiser out there looking at the property.
Absolutely.
Right?
Well, at least theoretically.
Right, and so and most of the appraisers are totally above board. They're trying to do a good job. So if you have some automated tools to identify the ones that are of concern, maybe that's all you should have.
Well, in the 2010 appraisal and evaluation guidelines, the regulators focus on the key phrase is risk-based review.
Exactly.
And so what we're talking about is a series of rules and a score to, if you will, bucket or segment the risk, and to place the riskiest appraisals in front of the best reviewers.
Exactly. And you can expect, I mean, you get some of the ones that have the most flags, let's call them, that are indicating that there's some uncertainty about the value perhaps. You certainly want someone to take the time to look at that and spend the time on that. And if it's a cookie cutter house out of a neighborhood of other cookie cutter houses where there's an active market and you know that the comparables are representative, there's really not much that you need to look at.
Well, risk-based review is encompassing, it is first placing appraisals with the most risk in front of the best people. It is also allowing those reviewers to focus. So going through the report and having the software, the rules, and the score focus the reviewer where to look. And then if there are two or more appraisals, providing the tools to compare those so you see the differences. We see changes to these appraisals that come back and the appraisers change more than what was requested.
Exactly, and a lot of times the reviewer is surprised by that because
Exactly.
they're only looking for a portion, and the changes are over here in this other place they didn't expect.
And they don't see it, and so now they approve an appraisal that was changed in areas they didn't ask for a change.
Exactly. So it's a complicated business, and and banks, or what they're trying to do is to minimize the amount of time they spend on it, because that time costs money, and that money is eventually going to be paid by the borrower.
Right.
And so they're trying to speed up this process and automate as much as they can.
And comply at the same time.
Exactly.
So let's go back and talk about our disclosures. We visited with our general counsel, Neil Olson, about our disclosures, about giving copies of the appraisal. Now the reviewer comes along, they have a review, they don't change the value. They agree with the value, we're all good. Disclose or not disclose?
I think you've got to disclose.
So,
But I'm not an expert.
but give it to them. And so our clients go back and forth on this. They basically, many of our clients have said, if it involves value and it's a new report, we're going to give it out.
Yeah.
Just as a matter of precaution. And so it's a big deal. It's a big deal in terms of documenting the file. All of that analysis needs to be saved in the file.
It does need to be saved, and I'm sure that a lot of lenders are going to err on the conservative side and provide lots of documents to the borrower.
To start out with.
Right. And over time, there may be some pushback from the borrowers. I mean, why do they want all this? I mean, eventually they want to make the loan.
They want a yes or
really
no.
can't.
You're gonna do it? You're gonna say yes or no, and when am I gonna get my money?
Exactly. And so eventually a lot of that may go away. And anytime you change something, there's going to be a lot of uncertainty about that process. But hopefully over the next year or two, that will sort of settle out.
And it will. And I think that lenders will get more comfortable. One of the questions that surfaces is, why does it cost so much to originate a loan? Well, there's a lot of new regulation, and we haven't, as an industry, gotten our processes and procedures down yet. A lot of things are still manual. For example, ability to repay documentation is still a phone call. That's not very efficient.
No, it's not. And there are a lot of aspects of that. And you just think of that closing process where you've got the closing agent and the lender talking back and forth as they get closer and closer to the closing, trying to get all the documents right, and then you're still...
And doing it so ahead of time so the disclosures can be provided to the applicant.
Exactly, and then you've got the things that you need to get from the applicant at the last minute that you didn't think about. So, I mean, it's a complicated process, and with all the regulations, people are struggling to understand and make sure that they've captured everything that they need to. It's a big job.
It is a big job, and speaking of the last minute, we're in our last minute. We're out of time. This is F&C's Morning View. I'm Bill Rayburn with Bob Dorsey. You all have a fantastic week. Goodbye, Bob.
Goodbye.